Everyone blames Wall Street for 2008. The real story starts in a living room. 2003, a homeowner in Arizona walks into a bank. No down payment required, no income verification needed. The loan officer hands her the keys. She owns a house worth $500,000 on a salary that can't sustain it. This wasn't a mistake, it was policy. Banks had discovered something. They could sell these loans to other investors before the homeowner missed a single payment. The risk wasn't theirs anymore. From 2002 to 2006, subprime mortgages, loans to borrowers with weak credit, exploded from 8% of the market to over 20%. Banks issued them by the millions. Brokers earned commissions on volume, not quality. A home that cost $100,000 in 1998 sold for $200,000 by 2005. Prices doubled, then tripled in some cities. Everyone assumed they'd keep rising forever. Here's where the system broke. Banks bundled these mortgages into securities called mortgage-backed securities. They sliced them into layers, some safer, some riskier. Rating agencies stamped AAA on the top layers. AAA meant safe as treasury bonds. It was a lie. Nobody had actually checked if homeowners could pay. Wall Street bought these securities. Insurance companies bet they wouldn't fail. Everyone profited. The incentive to check whether loans made sense had vanished. It had been transferred, packaged, and sold to someone 3 steps removed from the original homeowner. By 2006, $2 trillion in subprime debt was circulating through the global financial system. 2006, housing prices stopped rising. 2007, they began falling. Homeowners walked away, their houses were worth less than their mortgages. Banks stopped issuing new loans. The mortgage-backed securities became worthless overnight, but they were everywhere. European banks owned them. Japanese pension funds owned them. Australian super funds owned them. September 15, 2008. Lehman Brothers collapsed. It was the largest bankruptcy in American history. The firm held $619 billion in assets. Nobody knew which banks held the toxic mortgage securities. Trust evaporated. Banks stopped lending to each other. Credit markets froze. Companies couldn't pay workers. Unemployment spiked. The system that connected Arizona homeowners to Japanese retirees had turned into a circuit breaker. The real explanation: the crisis wasn't caused by greed alone or by a single bad decision. It was structural. Banks profited from originating loans, not from whether they were repaid. Rating agencies were paid by the banks whose securities they rated. Regulators had no authority over shadow banking. Each participant acted rationally within their incentive structure. The system itself was broken. By 2010, the crisis had spread everywhere. Iceland's banking system collapsed. Ireland required a bailout. Greece's debt became unsustainable. The Great Recession lasted years. Unemployment peaked above 10% in the United States. Millions lost homes. Global GDP contracted. What began in a suburban living room became a global event because the financial system had become one interconnected network with no circuit breaker. One failure cascaded everywhere. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for new financial history every week, the patterns that shaped how your money actually works. This video is for educational and informational purposes only and is not financial advice. Always do your own research.